The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone, and thank you for joining us for today's free webinar, Seed Funding Your Startup, with Kristen DeBacco from Fenwick & West and Cirque Rowe from Early Growth Financial Services. My name is Gina Longmire, Marketing Manager for Early Growth Financial Services, and I'll be your moderator today. This presentation will run about 40 minutes. If you have questions as we go along, please feel free to enter them in the question field or tweet them to us at earlygrowthfs with the hashtag seedfunding. We'll answer all your questions as they come along if we have time. If not, we'll save them for the question and answer period at the end of this presentation. If we don't get to your questions, we'll send out an email tomorrow with a link to the presentation as well as our presenters' emails. I want to start by introducing our presenters. We're very pleased to have with us today Kristen DeBacco. Kristen is an associate with Fenwick & West LLP, where she focuses her practice on strategic counseling to emerging and high-growth companies, primarily in the internet, social networking, digital mobile, health, and digital media industries in all aspects of general corporate and corporate securities law, from formation and corporate governance matters to intellectual property and commercial transactions, to equity incentive plans and employment issues. She has negotiated and structured a wide variety of corporate transactions, including seed and venture capital financing, debt financing, corporate reorganizations, mergers and acquisitions, and initial public offerings. In addition, Christine has represented and advised several leading venture capital firms investing in technology companies. Welcome, Christine.
Thanks. Happy to be here.
Happy to have you. We also have with us Cirque Rowe. Cirque is the Chief Operating Officer for Early Growth Financial Services. Cirque has 25 plus years of finance experience, with 17 years serving in financial leadership roles with high-tech companies. He's an accomplished finance executive focused on leading early-stage companies through to strategic financial decisions. And as I mentioned yesterday on our webinar, I've come to find out he's an excellent golfer. So welcome, Cirque.
Not sure about that, but thank you very
You're
much.
welcome.
Great to be here.
We love having you. So before we get started, I was hoping each company could tell us a little bit about, or each presenter could tell us a little bit about their company. So Christine, could you start and tell us about Fenwick & West?
Sure. So Fenwick & West is one of the indigenous Silicon Valley law firms. We just celebrated our 42nd anniversary, which is a long time in the technology world. And we are exclusively focused on working with technology companies from very early stages through to, when a company becomes a public company. And we have a full service practice, so, corporate tax, IP litigation, but all focused on working with technology companies and specifically startup companies, which have their own needs and kind of idiosyncrasies. So we love the startup world, and I spend all of my time there, and it's a really fun, exciting space for us.
Great, thank you so much. And then Cirque,
do you want to tell us a little bit about it?
Yeah, Cirque, could you fill us in?
Yeah. Thank you, Gina. Thank you, Christine. Early Growth Financial Services, we are an outsourced financial and accounting services firm. And we like to say that we work in the SMB space, or the small and medium-sized businesses. Having started here in the Bay Area, when you say SMB, that typically means tech startups. And so that is one of our primary areas of focus. And we basically provide four types of services. We do corporate tax returns. We do 409A valuations for companies who are providing stock options to their employees. We do the day-to-day, month-to-month bookkeeping and accounting, which to us means GAAP compliant, accrual-based accounting with full balance sheet account reconciliations on a monthly basis. And if you're getting money from investors, they'll want to see these kinds of financials. And finally, we provide CFO level consulting services for any of the higher level type of stuff that you would typically go to a CFO for. And that may be things like financial planning and long-term planning, and helping with fundraising, and looking at bank debt versus equity, pricing analyses, basically anything and everything that you would go to a higher level finance person for. But we come in and do it on an hourly basis for companies at an earlier stage who don't necessarily need or want to hire people like that in-house and spend the money. We have offices around the country. We started here in the Bay Area. We also have offices in Los Angeles, New York, Chicago, Austin, Texas, Boulder, Colorado, and Seattle, Washington.
Awesome. Thank you so much. And with that being said, let's go ahead and get started.
Great. So let me just give a little bit of an overview of what we're going to cover this morning. And like we said, just if you have questions, you can enter them real time, and we will either address them as we're going along, or save a little bit of time at the end for questions. We'll talk a little bit about the bootstrapping stage, which is the very early stage of a company, when it's often 1, 2, 3 founders supporting the company through their savings, loans, credit cards, a mix of all of the above. Moving from that early stage, taking on outside investment, and what that means and what you need to think about. How you prepare for that stage, both from a financial and legal perspective. And then once you're ready to take that initial investment in, what are the different ways you can structure it? And we'll focus on the two kind of by far most common ways. One is convertible debt, and the other is Series C preferred stock. And I can talk a little bit about what we're seeing in the market right now, and we will direct you as well to some sample term sheets and other resources.
Fantastic. So, as we start a company, obviously the first thing you're going to be doing is you're going to be bootstrapping it. And when we say bootstrapping, it basically means taking any small amount of equity investment that you yourself are making, you and your founders. You may have a little bit of revenue coming in, and that's helping you do it. But basically, it's your own money. And then at this point, it's really about, okay, what can we do with the little money that we have, and just our expertise and our hard work, to get us to the level where we're going to be able to get an outside investment, and we're going to be able to get that kind of an outside investment at the valuation and hopefully lesser dilution, as much as possible. And so it's about execution. It's about getting a founding team together. You don't have any outside investors. You don't have anyone that you're answering to other than yourselves. So you get to basically do what you want to do, and you get to focus on what you want to focus on. The one thing that we always say, and I know Christine will agree with me, is as you're doing this, sometimes entrepreneurs just think, well, you know what, it's just my company at this point. I may have set up a company on my own, but it's basically just me, and so I'm just going to do everything from my personal checking account and personal credit cards, and that's a pretty large mistake to make. So definitely, as soon as you get your FEIN or the Federal Employee ID number, you should be setting up a separate bank account, separate business bank account, a separate business credit card, and you want to segregate your personal expenses and your personal transactions from your business ones. And there's a couple reasons for that. One is just for simplicity of accounting when you are ready to set up an accounting system and import a little bit of history, but more importantly, from a legal perspective, the segregating the two types of activities is going to allow you to have that wall between yourself as an individual and your company, so that you don't bring any corporate risk onto yourself directly.
Yeah, let me just jump in there. There's lots of reasons people incorporate and form entities, and one of the kind of most important reasons is that you don't want to have personal liability. So you form a separate entity, and for our startups, it's generally a Delaware C Corp, and that entity is a legal person as far as the law is concerned. So the entity can enter into contracts and hire employees and do all of those things. And generally, the stockholders and officers and directors will not have liability if the company breaches its contracts, or there's accidents or things like that. But we call that protection the corporate veil, and it's something people spend a lot of time in law school studying. But that protection is only there if a couple of things are done. And one is the people running the company really need to respect those corporate formalities. They need to treat that entity like its own entity. And like Cirque said, it means the company has its own bank accounts. You have board meetings and minutes, and you kind of run it like it needs to be run. And if that's the case, then you've treated it like a separate legal person, and the court's not going to look through it and say, actually, you have a company, but not really, because you're not treating it like a company. So it's important that you aren't paying company debts out of your bank account and paying employees directly out of your bank account. You need to really respect the formalities that a company needs to have, or you do expose yourself to personal liability, which is not a good place to be. The other situation where a corporate veil could be pierced, or where they look beyond the corporate formalities, in the case of fraud. So if you don't commit fraud and you are treating the company separately, you know, the corporate entity will be respected, and you will you know, not have personal liability, with a couple of really narrow exceptions.
Great, fantastic, Christine. So, as we go from bootstrapping, the next step is okay, what do we do next, right? We're kind of, we've made a little bit of progress. You have an idea. You may even be doing some product development, or you may even have a couple of customers, and now you're kind of trying to figure out, okay, how do we take it to the next step? And so the next step really is now looking at outside investment, and probably the easiest, Gina, if we could move forward to the next slide, probably the easiest or the most common is to just borrow some money from friends and family, right? You have family members, you have friends who know you, who love you, who support you, who want to back you. And initially, if you just need a little bit of money to kind of get going, and prove out your product, before you really are ready for outside investors, then you're probably going to be talking to your friends and family about borrowing some money for them. And when you do, it's really, I think we can talk about, what the paperwork is going to look like and what the agreements are going to look like, and all that's important. But first and foremost is kind of what this picture shows, right? I know it's old, but I think it really hits the point that what you need to think through is that these are the people that you have lifelong relationships with. These are the people that you're going to be sitting across the table at Thanksgiving and over the holidays for the rest of your life and the rest of their lives. And you have to ask yourself, okay, do I understand the risk? Do the family members and friends understand the risk of investing money at this stage of the game in a venture like mine? Because in most, it's not a case where it's like, okay, if things go well, I'll get my money back, or I'll make a return. If things don't go well, I'll get 80% of my money back or 70% of my money back. In most cases, if it doesn't go well, they're going to lose 100% of their money. And so you need to understand that. They need to understand that. You have to be very, very transparent about those risks. And it really needs to be money that if they lose it, they're not going to bat an eye. Should not be grandchildren's education funds. It should not be their retirement funds. It should be really money that they can afford to lose completely, and not have it be an issue. And that's really the only way that you're going to be able to sleep at night. And that's just as important as the actual money that's being taken.
Yeah, and on a related point, that's a great point, Cirque, because the startups is very, very high risk, and like Cirque said, if people aren't prepared to kind of write the money off and just maybe see it as a lottery ticket where it may result in upside, but it may result in nothing, then you shouldn't be taking their money. And that ties into a really important legal point about securities laws in the United States. And the Securities and Exchange Commission, the SEC, and all the state authorities, there's a pretty complicated set of rules and regulations around who you can and cannot sell securities to. And if something has a equity component, and we'll talk later about convertible debt versus Series C, but if something is a straight up loan, meaning I'm loaning you $10,000 and I don't have the right to convert that into stock at any point, it's just a straight up loan, then that's not a security from the law's perspective. So anybody could lend you money. There's other rules that apply, but if you're talking about securities, which is debt that can convert into equity, or it's just straight up stock, then you need a valid securities exemption to be issuing, those securities to people. And think of the law this way: if you're a public company, then that's a securities exemption, right? You've gone public with the SEC. You file your financial statements and all your material information, and that's how investors, know whether they should invest in you or not. But if you're not a public company, and of course, startups are not, then you need to find another securities exemption as a way to be able to validly issue securities in your company. And there's not that many of them, actually. One is for employees or consultants, and that is a whole regime that's in place. And the other most commonly relied upon exemption is the accredited investor exemption. And this applies when you are thinking about taking debt from friends and family that will convert into equity. And I think it's something founders forget, and it surprises them when I tell them quite often, actually. They say, well, but it's just friends and family. Well, friends and family is a term of art we all use, but it's not something the SEC recognizes. It's not a legal term. It's just kind of who people often go to at the get-go. But it's important to remember that if you're going to take convertible debt or Series seed money from friends and family, they need to be accredited. And you can sort of Google what the test is, but at a high level, it's an income of $250,000 or more, or $300,000 with their spouse, or they have $1 million in net assets, excluding their principal home. So, that's not a huge threshold, but it means someone has a very decent income level, or they do have some money set aside other than their home. And there's ways we validate that for people. We have the investors fill out a questionnaire because it's the company's obligation to take reasonable steps to make sure that the investors they're bringing on board, including friends and family, are in fact accredited investors.
I think that's an absolutely fantastic point, and you're right. Entrepreneurs don't think about that, when they're just taking money from friends and family. So, yeah, that's a fantastic point, Christine. Okay, so after that, then if you're kind of at that stage where you are thinking about or you're getting prepared to talk with professional investors, then these are some of the things that you need to be thinking about and working towards, right? And when we say professional investors, we're talking about angels and VCs, and for the most part, the major differences. Those lines are starting to blur. I mean, you can say that angel investors, as a whole, are smaller than VCs, but really, I think the real definition is that angel investors invest their own money as opposed to VCs raise money from outside, funds, pension funds, and invest it on their behalf, and them being managers of that money and usually putting in their own, but they're using other people's money to invest in startups. But as you're getting ready to talk to them, what you really should be thinking about is, okay, well, what kind of money am I targeting? What kind of space am I in? Which are the angel investors that it makes sense to? Am I ready? Is it going to be a big enough round? Is there a big enough opportunity? And can I get the valuation that I need for it to be a bigger round? And maybe it's a Series A or a seed, a bigger seed, as opposed to an angel investment. Those are things that you want to talk about. Or think about. But as you're doing this, really, it's kind of the planning, right? It's the understanding of your model. It's your understanding of your business. It's the understanding of your market opportunity, business opportunity, and really putting kind of the pieces in place to be able to talk to them. And so we talk about obviously things like you got to put together an executive summary, and you got to put together a pitch deck, and you have to put together a financial model, and you need to kind of get ready for the rigors of fundraising, and that's probably kind of beyond the scope of this presentation. But the one thing that I wanted to just really touch upon here is the importance of understanding your financials, understanding your market, understanding kind of not only the tops down opportunity, but the bottoms up. Really, what is it really going to take for me to do what we need to do? And I always tell entrepreneurs, look, start with milestones, right? Figure out kind of backwards to forwards, the milestones that we need to hit in order for us to be successful, in order for us to continue to grow, in order for us to continue to increase the valuation of our company as we go through multiple rounds of financing. And it's those milestones and being able to hit those milestones that are going to be able to do it. And from those milestones, then do a bottoms-up projection of the revenue that you're trying to hit, or other types of milestones. It may be eyeballs, it may be units, it may be whatever it is that's important factor for your company. But really, model the financials based upon those milestones, and it really has to be, it's a story, right? The financial projections are a story of what you're trying to do, the opportunities that are in front of you, and the resources that you need to actually hit those milestones and to deliver returns for the money that you're raising.
Great. Okay, so I think we've kind of set the stage about where people start and the journey to taking on investment. And when you're ready to do that, you need to think a little bit about, well, what's the structure of this investment going to be? And when you're out there, telling people about your company and how excited you are and that you want to raise money, Anybody who kind of has any level of sophistication will often ask, well, what kind of round are you raising? Are you doing a convertible debt round, or are you doing a Series C preferred stock round? And so we want to talk to you a little bit about the differences between the two, because there are big differences, and when one makes sense, and when the other might make sense. So convertible debt, and we'll talk more about what that means, but we're generally seeing that for companies raising under $2 million. Certainly under 1.5, but generally under $2 million, because that's relatively small raise, it just generally makes sense to structure that as convertible debt. When companies are raising more than 2 million, we generally see that structured as Series Seed preferred stock. I've certainly done Series Seed rounds between 1.5 and 2 million. I don't think they make a ton of sense, and I've certainly done convertible debt rounds, bigger than 2 million. I think if as a company you can do that, that's great. I just think at that point, most investors will expect you to do a Series Seed priced round. Okay, so what's the difference? And let's go on to the next slide. Convertible debt, people call that a note round. They call that a promissory note. There's lots of different terms people use. They mean the same thing. What it really means is that you are taking money in from investors that at the outset is debt. It's not equity to start. It's just debt. And that distinction is important for a few reasons. One of which is, if any company is to go under, there's a hierarchy or an order in terms of who gets paid back, and debt always ranks ahead of equity. So debt holders get paid first, and whether that's the company's credit card debt or note holders like this, or your landlord, debt holders get paid first, and it may not be 100 cents on the dollar, but it's divided between them. And then if there's money left over, which there usually isn't in kind of a bankruptcy scenario, then the equity holders, stockholders, get a piece of that. So at the get-go, these people are debt holders, and they're loaning the company money. But there are terms in the debt that say that in certain circumstances that debt becomes equity. So it converts to equity, which is why we call it, convertible debt or convertible promissory notes. So there's sort of the very simple terms, and then there's kind of other terms that get negotiated. But the beauty of these convertible debt rounds is there's only 5 or 6 things you really kind of need to agree on with your investors. And the rest, assuming they're reasonable people, and they're willing to sign standard documents, which, by the way, should absolutely be the case, the rest is kind of simple language. And that's why they're pretty simple and relatively cheap to paper. So, the first thing is, well, how much money is the company raising? And that can be from one or more investors. What's the interest rate that will accrue on the debt before it converts? So while it's still debt, there's interest ticking. And that interest stops, of course, when it becomes equity, but while it's debt, interest does accrue. And we are typically seeing 4 to 6%, I would say, is market right now. So it's certainly more than you're going to get if you go buy a bond or put money in your savings account, but it's not 10, 12, 14, 15%. It's a fairly nominal rate of interest, but it's meaningful. The third kind of simple term is, well, what's the maturity on the debt? When does it become due if it does not convert? Because you may not raise a round in the period of time, and we're typically seeing 12 to 18 months is very, very standard, anywhere in there, and it's usually 12 or 18. It's unusual to see something in between. Some pretty sophisticated VCs will not do anything longer than 12 months. But many people, including angels and certainly friends and family, will often agree to 18 months. And if you can get 18 months, I would encourage you to do that, because I think longer is better here. So those are kind of the most simple, basic terms. And then you get into some of the other terms. And one is, well, when does the debt convert? When does it become equity? And this happens upon what we call a quote-unquote qualified financing. And that is just a term that people use, and it's a term that gets defined in your legal documents and in your term sheet. So what level of a round do you have to go raise, a priced equity round, by the way, such that your debt will convert in that round and become stock? And typically I see the number set at $2 or $3 million, usually excluding the notes. So if you raise $1 million in notes, and you go do a Series C or Series A round, where you're raising $3 million, then you're getting $3 million in new money, and that $1 million in debt becomes stock. And the question though is, well, how does it become stock, and what what are the terms under which that happens? And we'll cover that on the next slide. I think the other sort of more negotiated term is, well, what if I do a financing that is not qualified financing, so I only go raise another $1 million? What happens to my debt then? The third kind of more negotiated term is, well, what happens if I sell the company before I go do a priced round? And we've seen some of those instances, right? Google gets wind of this really cool technology, and they want to grab it before the company goes and raises money and is maybe not interested in being sold at that point. And so what happens to your debt holders then? So let's go to the next slide, and we'll dig a little deeper on each of those.
And Christine, could you also I'm not sure if we were going to touch it on the next one, but I know the other question that always comes up when we talk about convertible debt is valuation caps.
Yeah, definitely we'll talk about that. Great point. So this comes in when we talk about convertibility on a quote-unquote qualified financing. So there's a few issues here. One is, what's the level of a raise that will cause these notes to convert? And like I said, we're typically seeing $2 or $3 million, most often excluding the notes, so that would be new money. And by the way, this is a preferred stock round. It's not another debt round you go do. So it's a financing where you are putting a price on your shares. And then the other, very important question there is, well, on what terms does the debt convert, right? So if you're selling your Series A round at $1 a share, it's not that every dollar of debt becomes one share, because your note holders have to be given some reward for their risk, and that 4 to 6% interest is not it, right? That's not enough to kind of incentivize them and compensate them for the risk they've taken by lending you money early. So there's two ways that this happens. One is what we call with a discount, and these convertible notes always have a discount. It's just a question of how much. And when we say discount, what we mean is this: if you're selling your next round at $1 a share, your convertible debt usually converts at a discount to that. So it's either at 85% or 80% or something like that. So they get a 15 to 25% discount, I would say. And so you negotiate a range, but I would say 15 to 20 is market. So they're going to pay, 80 to 85% of what the investors pay. So their $1 million gets them more shares than a new investor who's going to write you $1 million check. The other component, though, is what we call a valuation cap, and this is what Cirque was referring to. And you'll hear people say, are you doing a capped note, capped convertible note? This is what they mean. And when you have a capped note, which I would say the majority of convertible rounds have a cap, not all of them, and that's a question of negotiating power that the company has. But I would say the majority of note financings that we see do, in fact, have a cap. And what that means is the investors get the better of a discount or a valuation cap. So whichever is better for them, that's how their debt converts. And what the cap means is you set a valuation cap, and we're probably seeing them for a very early stage company, like maybe $4 to $8 million is the range of caps we see. Let's say it's $5 million. What that means is if you go out finally and you're able to raise money from Kleiner Perkins at a $10 million pre-money, your investors convert as if that round was priced at a $5 million pre-money. So their money's going further, and they'll get the better of the discount, or as if the round was being done at a $5 million pre. And we run those numbers for our companies, and we'll say, okay, well, the better deal here is the $5 million cap, and that's how the notes convert. And the reason investors like that term is because it gives them some protection. Because if you manage to hit it out of the park with the money they've loaned you, and you can go get a $20 million pre-money from Kleiner Perkins, their note money doesn't actually go very far, because even with a discount, you have such a high valuation that their debt is not converting into very many shares. And so this cap concept is really a middle ground between just a straight up discount convertible note and doing a Series C priced round. It's sort of somewhere in the middle. It still keeps you with a note structure, which is simple and easy and relatively cheap to paper, but it does give the investors some protection that their money's not going to convert at some crazy high money valuation that the company manages to get. So that's what happens when your notes convert on a qualified financing. But sometimes we see companies go raise, they're doing a seed round, and it's maybe not as much money as they'd hope, but they are doing a priced round. And so what happens to the notes then? And that's one of the things you need to think about and negotiate. And I would say typically what happens is the notes don't automatically convert, but you give investors the election to convert if they want. Probably not at a discount or cap, but just at whatever the new investor's paying. And if they say, you know what, I don't really like this deal, I don't want to convert, then that's fine. They just sit there as debt, and when you eventually go do another round that triggers it, then the debt would automatically convert. Another term that gets negotiated is, well, what happens if the company gets sold before you do one of these financings? So, a very early exit, and without a specific term on this, all that would happen is that the debt holders get paid their principal and interest back, which I think most people agree is probably not fair. If you've managed to sell the company, it's probably because you've been able to take this note or debt money and build something great that somebody wants to buy, and your debt holders should be compensated for that. And so what we're typically seeing is 0.5x to 1x premium on a sale before debt converts. And what I mean by that is if somebody loans you $100, and let's say there's been $7 in interest that's accumulated, if the company is sold before you've repaid the debt or before it's converted, then if it's a 1x, the investors get their $100 back, they get their $7 in interest, and they get another $100. And if it was a 0.5x, they would get $100 back, they'd get their $7 in interest, and they get another $50 as the kicker, as we call it. So I think 0.5 to 1x is very market, and once again, that's just to compensate your investors for the early risk. I think, this is a very unusual situation where a company is sold before they go do a preferred stock round, but it's not unheard of, so it's something investors want to protect themselves against. Some of the other terms are, prepayment. Can the notes be prepaid? And often it's the company cannot repay them early. They either convert or they or a sale happens. But the goal, the investors are not investing here to give you a loan. They want this converted to equity, and so it wouldn't be fair if the company could just take the money and from somebody else and pay the note holders back. So that you can't prepay without the investor's consent. Closings, quite often you'll see that not everybody invests their money at the same time, so you have this staggered or rolling closing. And typically I see that period from 90 days to maybe as long as 6 months. Although if it's only a 12-month note, 6 months is kind of long. But generally I would say not during a 90-day period. Then you take in the investor money over that period because you're probably not going to get everybody to write you a check on the same day. Okay, let's go to the next slide. Cirque, before I jump into Series C stock, is there anything else you want to chat about on the note front?
No, that was such an incredibly thorough discussion and description and explanation of convertible notes. So thank you very much.
Great. Okay. So Series C preferred stock. So this is now a priced equity round. So there's no debt component. You are selling stock to investors. So preferred stock in the company. And the Series C can sometimes be the very first raise you do. So you skip the notes and you go right to convertible, right to the Series C, or it may be the first thing you do after convertible notes. So maybe you do a small convertible, debt round of $500,000 or $600,000, and then 6 or 8 months later you go raise a Series C round and you raise a few $1,000,000. That's both of those are typical things we see. So neither one of those is unusual. Now, when you go raise a Series C preferred stock round, there's a few things that are most heavily negotiated. One is, what's my pre-money valuation? So what is the company worth before the investors invest money in the company? And that's an important number because it determines what the price per share is. So you take all the stock that's outstanding, you divide the pre-money by that, and that gives you the price per share. So pre-money valuation is important, and it's the most heavily negotiated business point. Now, the beauty of the convertible note round is you have a cap, but you're not actually putting a valuation on the company, and that's one of the sort of really big benefits of the convertible note round is you kind of push that issue down the road, because if you're trying to raise money too early, that pre-money valuation might be too low, and you'll have to give up too much of your company, to bring money in. So that's why the convertible debt round on this front is much preferable. But we're in the Series Seed round now, and you are negotiating your pre-money with your investors, and that will be one of the most, kind of heavily negotiated points. And, people say, well, what should my pre-money be? And, generally it's like, well, what's the best deal you can get in the market? And, there's sort of, people are seeing certain ranges for companies in different industries, at different stages. So, and that changes over time. Generally, my advice to my founders is, well, I don't think you should name you should say the pre-money first. I think let your investors say what they think the company's worth, and then you can kind of start from there. But this will be something you need to think a lot about is, what's the price we're willing to do? And, whether you're pre-revenue or post-revenue or what your metrics are will all factor into what that pre-money valuation is going to be. The other really big important thing that gets negotiated is, well, what's the size of the option pool when we close this deal? And the reason that's really, really important is because the more shares you have outstanding on a pre-money basis, the lower the price per share you will have for your stock, and the further the investor's dollars go. And the size of the option pool is generally expressed as a percentage of the post-closing cap table. And investors will want to make sure that you have enough shares reserved in your equity incentive plan or your option pool, it's the same thing, to go do the hiring you need to do between now and when you go raise your next round. And people use rules of thumb like, well, they want to see 10% or more commonly 15% of the cap table set aside. And, I think those market numbers are fine, and maybe they're a good starting point, but I think the better way to think of it from the company's perspective is, how many shares do I need between now and my next raise? Because that is often company specific, depending on what industry you're in or what your hiring needs are. And it often is a way to get investors off of this 15% rule of thumb, maybe to a smaller number, because that dilution is going to come almost always on a pre-money basis, so out of the founders. And so to the extent you can keep that option pool increase lower, it means less dilution. And you can always do an increase later, in which case everybody's diluted equally, but that increase done in connection with the financing only dilutes the existing stockholders. So I think you want to think about, what are our hiring needs? What are they truly? Do an option budget, so set out, the people you're going to hire between now and your next round, and figure out what percentage of the cap table that will be. And, I think go to the investors with that, which is better than just picking a number out of thin air, because that's the percentage your investor used in the last round. I think the other really important thing that gets negotiated at the Series Seed round is your board structure. And, the board is, I think, one of the most single important issues you need to focus on, because the board really determines the fate of the company. All material decisions have to be approved by the board. All equity issuances have to be approved by the board. And you want to give a lot of thought to the number of people on the board and what the structure is in terms of who can fill which seats and who's going into those seats. So it's something I spent a lot of time with my founders thinking about and strategizing about, because it is really, really important term. And I think, with some of these very founder-centric companies, Facebook's a great example. Mark Zuckerberg, I think to this day, still controls the board. He's very thoughtful at each stage about the number of seats and how many seats he could fill and how many seats the investors could fill, and making sure that he had the ability to, control the vote. Not everyone's a Facebook, and I get that, but you want to do your best efforts to be thoughtful about the board structure and who's going to fill those seats and who can control them. I think the other, and I think we're getting pressed for time here, so I'll move along quickly, but I think the other things to think about are, the company's going to have to make some representations and warranties, so they'll have to say certain things about the state of the company. The other thing to think about is, the beauty of the Series Seed, and we'll point you to the Series Seed website, but there are very slimmed down docs from the Series A. So Series A preferred is still preferred stock, but the Series Seed is really an attempt to, for smaller raises, right, that are not, $8, $9, $10 million like we're seeing now for Series A, for those smaller rounds, we don't think it's necessary to have the full-blown Series A documents. So Fenwick actually pioneered this initiative. It's seriesseed.com, and you can go there and see the form documents. And the beauty of the Series C documents is if you have your investors agree up front that we are going to do a Series Seed round and we're going to do it based on these forms, there's only a few things to really be negotiated, and you can do a round pretty quickly and cheaply if you and the investors are willing to use those forms. So just quickly onto the next slide. I think this highlights the differences between a Series Seed and Series A. And just really quickly, you make a few promises to your investors, which is when we go do a Series Seed round, we are going to give you the benefit of those new rights we give to the Series A or Series B investors. Whether you give, oh, I think we skipped. No, I think I skipped a slide. Sorry. Yeah, a couple things to point. Sorry about that. A couple things to point out is the Series Seed round, because it's slimmed down, does not have price-based anti-dilution protection for your investors. So that means they don't have protection against you doing a down round, and that's something Series A documents will have, but they don't have that in the Series Seed. The liquidation preference is non-participating. There are no preferential dividend rights. There's no redemption rights. We sometimes see the Series Seed have a board seat, which we talked about. And there's more limited protections and on voting rights for your preferred investors. So basically, we've taken a Series A, kind of kept the very core components that are critical for investors in the company, and it's a much more slimmed down version. Once again, with the goal of being able to do a round that's only a few $1 million in a pretty cheap and effective way. So quickly on to the next slide. A couple things to note in mind. You will be promising in your documents that if you go give your investors in future rounds, other rights, that the Series Seed will get the benefit of that. The right of first offer on future financings, this is often called pro rata rights, preemptive rights. Some people call it the right of first refusal. This is if the company goes to raise future rounds, do your investors have the right to buy a portion of that round? And this is optional in the Series C documents, although most investors will, I think rightly so, insist on it. There's some limited information rights in the Series C, but once again, it's more limited than the Series A. A drag along in the context of a sale is optional in the Series C. I think most times it's not there. There are no registration rights for your investors, and those are rights that they would have on an IPO. The theory there is, look, an IPO is a little bit of a kind of a ways away, so let's worry about those rights later. And no company covenants, so no things they're promising to do in the future. And no ROFR or co-sale rights. This is important for founders. When you bring in Series A money, you will have to put an investor right of first refusal and co-sale over your shares, meaning if you sell your shares, the investors, if the company passes, the investors have the right to buy those shares at the price you've negotiated or to sell some of their shares instead at that price. And this is something that we've punted to the Series A. So I think the next slide just shows us the Series Seed website. So I would check that out. Just a little plug here for Fenwick. We do a quarterly venture capital survey. It gets a lot of press and it has really interesting data on trends within the last quarter in terms of valuations and terms. It's quite an interesting read, I think, especially if you're in the process of raising money. So you can check it out on our website or actually even sign up to have it delivered automatically to you every quarter. So just to wrap up, I think this next slide is I think a good summary of the pros and cons of one structure versus another. And you can see, the pros for the convertible note are it doesn't require a company valuation. So you avoid having to put probably a low valuation on your company and give up too much, but you may need to negotiate a valuation cap. And I think that's a really good middle ground. It's pretty quick and cheap to paper, and we definitely see it for smaller raises. I think the cons from the investor's perspective is there's some valuation uncertainty. The cap gets them part of the way there and gives them comfort, but they're not putting a priced valuation, on the shares they're buying. They're not even getting shares; they're just getting debt. On the Series Seed, from the investor's perspective, there is definitely more definition around what their rights are. Importantly for them, if they buy Series Seed stock, their long-term capital gains clock starts at that point, versus if they're buying debt. And there's some debate about this, but the sort of prevailing wisdom seems to be, well, the capital gains clock does not actually start until that debt converts to equity, because that's when they've actually acquired a security. So that can be important for investors if there's an early exit. But once you pass the 1 year mark, then it doesn't really matter. Series Seed is not as cheap as a convertible note round, but it's cheaper and quicker than a Series A. I think the cons of the Series Seed is that it does require negotiation around valuation. That's a big con of the Series Seed. Higher legal fees than convertible notes for sure, and just generally more expensive from a process and legal perspective than convertible notes. So, I think if you're raising, like I said, under 2 million, certainly well under that, you really shouldn't be doing anything but a convertible note. If you're in the few $1 million range and you don't have the negotiating power to do a convertible note, then you're definitely into the Series Seed realm. So it's really kind of if you're at the $2 million mark that it can kind of go either way. And then that's a question of really how much negotiating power does the company have? And if you have a lot and you have a lot of demand, then you can drive terms. So really it's just a function of how much interest you have, how hot is your company, and if you have a great answer to both of those, then you can probably put people into a note structure, which I think is just better for the company, certainly. So that is a lot of information we've just downloaded. Sir?
No, sorry, I don't mean to interrupt you that
Yeah,
once, but very, very informative. Do you guys mind if I ask 2 questions, or Cirque, do you want to say something quickly before I pop in with some questions?
Yeah, let me just a couple of points that I wanted to make, and I think we still have enough time for some questions. But I think some of the comments that Christine made about the option pool and how you plan for that option pool, it does have a pretty big impact on the equity that the founders continue to maintain after the round of financing. So again, it kind of comes down to really understanding your business and understanding your model and understanding the resources you're going to need, the people that you're going to have to hire, at what levels, and what kind of stock options you're going to have to give to these employees to incent them to come aboard. And not only does that help you from a negotiation standpoint with investors on the stock option pool, but what it also does is it also increases confidence level in your investor's mind about you and your knowledge about exactly what it's going to take to be successful. And I think that'll also go a long ways, as part of your negotiation. The final point that I wanted to make, and so I think, again, kind of, the whole planning thing is really, really paramount. The final point that I wanted to make is just, I mean, if you really think about kind of the information that we just described here, you can see that this is pretty complicated, right? There's a lot of stuff to understand, and even at a very, very high level, we can understand it. But some of the nitty-gritty, some of the details are really where it's really important to have a full understanding. And this is where I would say, one of the first questions that I ask when we're talking with prospective clients and with clients is, who are you using for your attorney? Right? Because a lot of early stage companies, they might have just started, using a small law firm down the street, or their parents know a lawyer who can help them get their company started, and that's how they start. But once you get to this level, I can't stress enough the importance of working with an attorney who understands this inside and out, and like the back of their hand. Because as you can imagine, them being able to talk you through these details and what it means and the impact it's going to have is going to be so critical for you to get the best terms, to put yourself in the best position to close around the financing, and hold on to as much of your company for as long as you can. And so, working with someone like Christine and with Fenwick, who is focused strictly in this space at this level of the game, even more so than some of the bigger law firms who are kind of way much further along the food chain in terms of working with bigger companies. I think is something that you really need to do when the time comes.
I'd agree with that, Sirk, and thanks for the plug. Whether it's Fenwick and there's three or four other firms who are are peer firms and are equally they're good in this space as well. You just need to find an attorney who does this day in and day out, and that may be more expensive than the guy who does your mom's estate work. But if this is something you're serious about, you really need to be working with people who know what they're doing. And really, frankly, I think from the very get-go, even when you form a company that you want to be a high-growth company, it's formed in a certain way and with certain things in mind that you wouldn't have in mind if you were forming a company to open a restaurant or any other type of business. So you really need to start with professionals from day one. And there's lots of deferral and other kind of fee arrangements that us and our peer firms will do. And so there really is not any reason not to start right and to start early. The other thing I see founders do sometimes is they incorporate online, or they start with somebody who doesn't do this for a living, and then they want to switch while they're trying to raise money. And I actually just came off a situation like that where a pretty high profile company was raising its seed round, and they've been working with a firm that was great in what they did, but it was a different space. And they came to us as they were negotiating their term sheet, and we helped them with the term sheet. But then we had to do the whole onboarding process for the company, and it literally slowed the financing down by probably 4 or 5 weeks, because we needed time to go through the company's records and fix things and figure things out. And it's really just not an ideal time to be switching law firms. So I think, and this goes the same for accountants and other professionals, is start with the right professionals from the get-go. And I assure you, in the long run, it will save you lots of time and money. And it also really has a very important signaling effect to investors and other people, because they will take a lot of comfort in the fact that you're represented by one of 3 or 4 law firms, because they know that things will be done properly and have market terms and all of that. So really, I'd encourage you to A, incorporate as soon as possible, and B, do it with somebody, whether it's Fenwick or our other peer firms, somebody who does this for a living.
Couldn't agree more. Okay, Gina.
Questions?
Sorry about that.
That's okay.
Hey, Gina.
Sorry, I could not unmute for some reason. Okay. Questions. The first question we have is, can you clarify the terms? Can you hear me? Can you hear me?
Yes.
Okay, sorry. Sorry, for some reason I kept hitting the video icon instead of the mute button. I was like, what's happening? Okay, first question is from Julian Bleeker, and it says, can you clarify the terms and differences between pre-money valuation in the Series Seed priced round and valuation cap in the convertible debt financing?
Sure, and I'm happy to take that question from Julian. So the pre-money is, when you're doing a seed round, it's actually the price, the valuation used to put a price on your shares. So everybody, it's what the stock is being sold for, and in fact, often it means what the liquidation preference is. Usually we have 1x, so if people are paying $1 a share and they have a 1x liquidation preference, then that 1x liquidation preference is $1 a share. So it's actually used to determine the price per share. Versus a valuation cap is really just for your investors. So it's the cap at which, really it's just ensuring a different type of discount. It's the cap at which their notes will convert, but that's just for those note holders. Everybody else is actually going to pay the Series C price per share, which is a function of the valuation used for that round. So think of the valuation cap as just really kind of the mechanism to determine the maximum price that those investors will pay. But everybody else in the round, when you do a priced round, is going to pay the price as a result of your pre-money valuation. So they come up in different contexts, and I think the pre-money valuation is a more heavily negotiated point, because you're actually putting a valuation on the company, and that is determining your price per share. I think the valuation cap is less negotiated, because it's really just going to apply to your investors.
I think one example that I could use, and Christine, correct me if this is not 100% accurate, but I think at a high level it is. Imagine if you're kind of trying to do an apples to apples comparison between between a pre-money valuation versus a cap. Imagine a company that, let's say, is we put let's say there's a $5 million cap, as Christine said, and now the company is actually going to be raising money at a $5 million pre-money valuation. There'd be no impact. There'd be no difference. If it was a $3 million money valuation, there'd be no difference. But if this pre-money valuation of this company is going to be set at $10 million, then the people who had put in money at that $5 million cap would be getting a lot more shares for that money than they would have if they would have just come in at that $10 million seed financing round.
Right. Yeah. In fact, probably twice as many shares or something like that. So yeah, exactly.
Okay, awesome. Our next question is Series Seed is still lower legal fees than a Series A, correct?
Yes. With one assumption, I've had people call a Series Seed round a Series Seed round, and then the investors proceed to want to use typical Series A documents. So, we're calling it a seed round, but it's not. I would say the fees are lower if we have everybody agree up front that it's going to be a seed round and we are going to use the docs on seriesseed.com and only make the changes we need to make to reflect the few negotiated things in the term sheet. Yes, then it's by far cheaper. But just calling something a Series Seed round, but using all of the Series A type documents doesn't make it any cheaper.
Perfect. And then the next,
And by the way, the naming of shares, right? Series Seed, Series A, Series B. I mean, that's just sort of convention. People could name these series anything they wanted to, but the convention is, a Series Seed, and then you typically do an A, and then you do a B. But if between the A and the B you do just maybe a mini round, you might call it an A1. So that's sort of how people use these terms. But there's no legal reason to call anything one over the other. It's just what people expect in the market.
perfect. Thank you so much. The next question we have is what should one include / how complicated does a financial slide need to be in a pitch deck?
So, I'll let you take that one.
Yeah, absolutely. So it should be very, very easy to see. So it shouldn't be a whole spreadsheet on the pitch deck. I'm a huge fan of simple graphics and charts as opposed to spreadsheets. You obviously need to do the work, and you need to have the spreadsheets as backup for when you do due diligence and to know those numbers cold. But simple graphics, like for example, you might say you might have a 3-year graphic with revenue and total expenses and cash balance, right? In 3 buckets for the year, and that's just enough. It really is to show about kind of what the in most cases at this stage what the revenue potential is going to be.
Oh,
Simple is what you want.
can you, sorry, my computer is going crazy on me. Perfect. The next question is, let's see. Is there a good resource to get advice on how to structure the first seed or note round before committing?
Your attorney would be the one to, I think, give you that advice.
That was a simple answer. I was waiting for you to elaborate maybe more.
It is.
All right. And then our last question that I have on here is, great. It says, first of all, just wanted to say, great talk, guys. Please let Christine know that we would love to speak with her about potentially retaining Fenwick's services. Thank you. And Christine, what I can do is offline, I can email you Colin's email address if you'd like, or Colin, in addition, as I mentioned, you will be receiving a link to Christine's email tomorrow, so you can reach out to her as well. So either way, we'll get that taken care of for you. And then do we have any other questions before let's see, we have one more that just popped up, it looks like. Oh, it says, thank you. That was great information. So yeah, if we have no other questions, that obviously brings us to the end of our presentation today. So thank you so much to Christine and Cirque for an amazing, amazing presentation. We hope you all enjoyed it, and we look forward to hearing from you guys again soon. As I mentioned, and looks like we have one more. I'm sorry. Oh, no, it's just everyone's popping on to say how great it was and how helpful it was. So good to know. We're so glad that you guys found it helpful and insightful. As I mentioned, you can feel free to join us for any of our free webinars. Our next one is February 17th, The Best Pitch Decks, How to Create a Winning Pitch Deck with Jim Fulton and Carrie McElroy of Cooley, Mark Phillips of Afar Adventures, and of course, Mr. Cirque Rowe of Early Growth Financial Services. You can register for this or any of our other free webinars on our events page at www.earlygrowthfinancialservices.com/events. And again, should you guys have any additional questions with regards to this webinar, please feel free to tweet us at earlygrowthfs, #seedfunding. Thank you so much to Christine and Cirque for today, and we look forward to hearing from you all again soon.
Thanks, everyone.
Thank you,
Bye.
everyone. We really appreciate it.
Thank you, guys.